The average age of a nuclear plant in the US is 50 years old. That means 50 years ago, we were able to build dozens of nuclear power plants quickly, cheaply, and they lasted forever. So why is it that in 2023 we can't do that? That's a choice. It's a political choice. It's a perverted political choice imposed upon us by radical environmentalists who are fundamentally Malthusian and anti-human.
Hello and welcome to Capital Cosm. Today we have none other than Doomberg on the show. Doomberg, thank you for coming on, my friend.
Hey, happy to be here and congrats on the launch. Happy to be such an early guest.
Awesome. Yeah, we're happy to have you on. For those who may not know who you are, Doomberg, can you give us a little background on yourself and why? What makes you focused on the energy and commodity space? What got you into this space?
Yeah, sure. I'm Doomberg. I'm the head writer of the Doomberg Substack. We're a small team of former executives from the commodity sector. A lot of specialty in energy and commodities, inelastic commodities in particular, on our team. We bring sort of a unique perspective in that very few people with decades of industrial experience are actually participating in the blogosphere. And so when we created our Substack 2 years ago, we brought that lens. We write about energy and finance and the economy at large, the three areas of focus. We dabble in crypto and a few other things that interest us over time. And we publish, 6 to 8 articles a month, and have grown to be a pretty large Substack with a lot of subscribers, and pretty thrilled to have accomplished that. And it's literally all we do now, effectively. And in the modern age of content creation, if you find what you were meant to be doing in life, my advice is keep doing it. And so we intend to just keep doing Doomberg for as long as we can.
Yeah, and I've heard you say that before in other interviews, and that's actually one of the things that you've said that kind of stuck in my head. I've really enjoyed making these videos, so I'm just going to keep doing them. Per the advice of Doomberg. Awesome.
Yeah. Well, if it feels like work, stop. That would be my other advice. We designed a life where we try to only work, quote unquote, on things that feel like we get to do them. And at the moment that this feels like a work or a drag or something that you have to do, then you have to question yourself as to whether it is truly your passion. If it is truly your passion, you'll never get that feeling.
Yeah.
Sure.
Yeah. And it'll reflect in your quality.
Yeah, it has to.
Quality of work.
It has to. 100%.
Yep. Great. So awesome. So the talk of town recently, which has been the talk of town for quite a while now, have been interest rates. So yesterday we hiked another 25 basis points. We're looking at probably another 25 basis points next go around. But earlier this morning, JP Morgan came out with a rate cut forecast. But with all this talk about rate hikes and pausing and rate cuts, do interest rates at all have any impact on energy prices or commodity prices? I mean, after all, whether or not we raise interest rates or lower interest rates, that doesn't really solve the supply destruction that we've seen over the course of the last several years, does it?
It certainly has a pretty significant impact in the shale patch in the U.S. And much of the shale gas and oil revolution over the past 2 decades, let's say decade and a half, has been driven, at least in part, by ready access to ultra cheap capital. And ironically, as Powell hikes rates in an effort to fight inflation, he is choking off capital for really one of the last great growth engines for energy in the world. Lou Gehrig famously said on a podcast I listened to a couple of weeks ago that effectively all of the growth of oil in the world comes from 6 counties in Texas, the Permian Basin. And to the extent that capital was readily accessible and easily torched, because to be clear, a lot of these companies didn't return anywhere near what the investors thought they would. To the extent that capital is no longer readily available, we do suspect that we'll see a turning over of U.S. oil production. And that actually could be a driver for inflation. So a sort of a secondary impact of the speed and magnitude with which Powell has raised rates is beginning to be felt in the oil patch as these oil and gas companies in the U.S., which have driven almost all the growth in the past decade that we've seen globally in the energy sector, are running their businesses for cash as opposed to growth. And you combine that with the pressures being put on the anti-fossil fuel ESG crowd, it becomes ever more challenging to get capital. And if capital is expensive, then people don't invest. And so there is an energy impact for sure, especially in the US.
Got it. Yeah. In regards to the Permian Basin, I read an article just a week ago, actually, talking about how its growth in the Permian Basin has essentially dried up, especially over the last year or so. So we've essentially hit peak shale, have we not?
So yeah, there's sort of two terms that you may be conflating there. Growth in shale has topped off, but that's because the Permian Basin is still growing a pretty decent clip, and that's offsetting, slightly more than offsetting the declines that we're seeing in the rest of the US. So the Permian Basin is the last key growth area. When you see that curve turn over, then you'll know that we have production issues in the US. And we're still 1 million barrels a day short of what our peak oil production was pre-COVID. We were at 13.1 million barrels a day, and we're at 12.1 or so today, last I checked. And for a while last year, of course, Joe Biden worked to sort of fudge that gap by releasing 1 million barrels a day out of the Strategic Petroleum Reserve. And that's no longer really an option. There's even some talk of them beginning to fill it, although we view such talk with quite a high degree of suspicion. Seems more political than physical. We're going to see. OPEC is meeting here soon, and the decisions that come out of there, whether they'll cut again, it's not off the table in our view. And so there's a sort of a lot of yin and yang pressure, from the Biden administration perspective. They want, low prices at the pump, but at the same time, if they crimp the fossil fuel industry and they don't invest, especially with the interest rate policies that we were discussing earlier, these things are cyclical for a reason. And so we shall see. One of the charts that I watch religiously on the Bloomberg terminal is in fact production out of the Permian. It's still growing, but the rest of the shale patch is certainly shrinking.
Right. And as you've alluded to just now, these things are very capital intensive. Like it takes $1 billion to build a rig, for example. So, if hypothetically, even if we were supposedly to get over the hard-headedness of this green energy policy, and we woke up from our slumber and just focused on building out the infrastructure, the capacity that we needed, how long would it actually take to play out? Like this isn't like a switch you can just flip and automatically you can just extract the energy that you need, right?
So it depends what form of energy you're talking about. I would say with the right environment and political support, you could increase U.S. oil production at a relatively fast clip. At least part of the issue has been ongoing regulatory attack on the industry. And look, when oil went to minus $37 a barrel, it brought in a phase where investors, having survived all of these bankruptcies and recapitalized, and the new entities that came out of bankruptcy, had this cash flow mindset, and this adds to the cyclicality. Now, what inevitably happens is people underinvest, prices spike, and everybody overinvests all at the same time. And so hence the cyclicality of the commodity sector in general. But there's it can be done relatively swiftly in the US. And the thing that you need to remember is with these highly inelastic commodities, it actually doesn't take very much incremental supply or lack thereof to drive prices in either direction violently. And don't forget, we went from minus $37 a barrel to plus $137 a barrel in the span of 18 months. And the swing in the supply-demand imbalance was a relatively small percentage of the production and typical production and demand. And so this is why, of course, we've been arguing since the beginning that the proper way to defeat Putin with sanctions was to flood the world with energy and crush the price. And if we had done so, we would have substantially hurt his revenue. Instead, we have tried to sanction his volume. And in the circumstance where we would have been wildly successful, he would have made even more money because it would have driven prices higher than we could have ever hoped to crimp his volume. And so this is one of the things that we talked about in my answer to your first question, which is a sort of fundamental understanding of commodity markets from direct experience. I survived many boom bust cycles in the commodity sector in my professional life, and you just know intuitively that. So, for example, if a commodity is tight and your plant blows up, and supply comes offline, if you have other plants, you're going to make more money from the plants that survived than you will have lost from the plant that blew up. But it's just the fundamental nature of highly inelastic commodities. And so trying to attack Putin's volume was always foolhardy. And so to your question about the speed with which we can bring new supply online, you always have to remember what is at the margin and how much can we bring on at the margin to affect price. Price is not set at the base, it's set at the margin. Okay. And so we could certainly bring on new supply relatively quickly if the price is right.
Understood. So you also brought up the fact that, ironically, raising interest rates might actually have higher inflationary impacts downstream, because you raise interest rates, it makes it harder to finance, these highly capital intensive energy sectors, which then drives supply down, which drives prices up, et cetera. It's cost push inflation. With that said, why, and also, if the inflation rate's being reported at 4.9%, that's using a new methodology that was introduced in the last 15, 20 years, I believe. The real inflation rate, if you measure it using 1980s methodology, brings us to about a doubling of the reported inflation rate. So even with interest rates being at around 500 basis points, there's still a gap between the actual inflation rate versus the actual interest interest rates. So between those two items, the fact that the Fed funds rate is still well below the actual inflation rate, and the fact that the rate hikes may actually be having unintended consequences driving up inflation. I mean, if I know this, and certainly they should know this, and if they do, why are they pretending to fight inflation? What's the actual end goal here?
So a couple things. First, what you're describing is something that we predicted last year, which is that we would enter into a period of stagflation, which is a period of elevated inflation and restricted economic growth, at least in real terms. Yeah. And so we're seeing that. And in fact, we had a massive signal that was coming last year, which when you correct for the energy content and units of trade, coal, dirty thermal coal, was selling at a premium to oil for several weeks last year, which by our analysis had never happened in the history of the energy markets, at least as far back as our Bloomberg will give us data. And that was a very curious thing. Like, why would coal, which can only be burned to produce heat, be selling at a premium to oil, which, in addition to being able to be burned to produce heat, also has the flexibility of being refined into diesel and jet fuel and gasoline and adhesives and pick your favorite. The entire chemical industry flows out of a barrel of oil. What was that telling us? And what that was telling us was there's a desperate shortage for energy at the time, and there was no need for finished goods, which in our view sort of just felt like it was signaling stagflation ahead. And that's in fact what we're seeing, which is, elevated inflation in the US and an economy that's kind of stagnating. Now, there's all kinds of flows in China reopening versus last year, which makes year-over-year comparisons a little bit, rosy and so on. But by and large, I think what you're describing is the situation that occurs when the world is fundamentally short energy, which is stagflation. Energy is in short supply, which means everything gets more expensive, but it's difficult to grow because energy is so expensive. To your question about whether they should know that, in fact, they don't. The question of malice versus incompetence comes up a lot, and we're normally in the incompetence camp. Very few people in government have any relevant experience in the industry whatsoever, and it would surprise you how little they know about how industry actually works. And then when you sort of superimpose that against their confidence in their knowledge of how industry works, that's how you get situations like, the German energy fiasco, where a bunch of bureaucrats who have no idea what they're doing basically run a country. They think they're doing the right thing. I mean, we genuinely who wants to live in a world where our political leaders are proactively destroying society? It's much better to live in the incompetence camp, at least for your own mental health.
Yeah, yeah. And in case of Germany, I think the most recent numbers were 0% year-over-year GDP growth, 2% interest rates, and then with a 7% inflation rate. So even at, they can't raise interest rates without crashing their bond market, or the euros, the ECB's bond market, can it?
It's a little complex, of course, because you have this sort of supranational structure at the European level, and then you have Germany being such a strong voice within that union. I would point you to the producer price index, which is just an amazing chart to look at. At least the official numbers topped out at 46% this year in August and September, and then now it's all the way back down allegedly to 6.7% as the energy crisis has sort of abated, thanks to the mild winter. Imagine what would have happened in Germany if they had had a particularly cold winter. Like, it's pretty amazing to think about how close they came, and yet they are still taking sort of all the wrong lessons. They are confusing dumb luck with sound strategy, as we said in a recent piece. It's pretty amazing to watch. And as we've said oftentimes, we're not sitting here hoping for a catastrophe in Germany to be, quote, proven right. We have many German subscribers, and Germany is a great country, and I personally visited it several dozen times, enjoyed every trip. They're very industrious people with great sort of background of engineering and manufacturing, and a true economic miracle. And it's really sad to see what's transpiring over there, if you really think about it. But they were blessed by the whims of Gaia for this winter, and let's hope that happens again coming up here in a few months.
Yeah, and they recently, they've shut down the last remaining nuclear power plants that they had in operation there a couple months ago too.
Worse than that, they're mandating increased demand because they've got this crazy law which effectively outlaws furnaces. And so, in fact, any new furnace installation in Germany starting next year will have to have a quote, at least 65% of its energy come from renewables, which effectively rules out oil and gas furnaces. And concurrent with that, of course, they're trying to rule out the internal combustion engine. So they're trying to drive all this electricity demand onto their grid while they're taking down baseload power like nuclear. And ultimately, the only way to keep the lights on reliably is by retreating back to coal. And there's this fantasy within the Green Party in Germany that somehow they will be shutting down coal plants next year and they'll be off of coal by 2030. And I will predict today that Germany will set a record for coal consumption in the year 2030. Either that or their society will collapse.
Yeah, either case. So it looks like we're kind of in the best of both worlds, if you want to put it that way, in terms of our current commodity super cycle or the energy crisis, whatever you want to call it. We have the supply shortages of the 70s, but we also juxtapose that with the demand of the 2000s, with China coming online. You have all of these developing countries needing more and more energy to modernize and get up to speed with the rest of the world. So do you see any, those are the those are the similarities behind past commodity bull markets, but do you see anything different this time around versus those other two occurrences?
There's a couple of factors that are hard to model, which is the sort of emergence of this vast population in Southeast Asia that aspires to join the middle class. And if you look at the, energy consumption per GDP, as a function of population, and you see where these countries stand on that chart, it's pretty scary. There's going to be we believe, a boom in the demand for increased standards of living. The proliferation of the internet means the rest of the world gets to see how the Western world lives. And as a general rule, all humans everywhere want a higher standard of living, right? For your children and for themselves and for their friends and family. And we wrote a piece on end-of-life tires recently, and the numbers are kind of staggering. The U.S. produces 6 times as many spent tires per GDP as the next six most populous countries in the world, which represents a population of 3.7 billion. Like, it's pretty remarkable when you just think about the number and how far ahead we are relative to this population set, which is an order of magnitude bigger than the United States. So there's 3.7 billion people producing 1/6 the number of waste tires that we do in the US. It's one of those statistics that just boggles the mind. And it's just really staggering. And we got that number by inspecting the vehicle ownership per capita. US has more than 800 vehicles per 1,000 people. And the six most populous countries in the world, not named the US, averages something like 129 vehicles per 1,000 people. So you just factor that up by 6 and then multiply it by 11, and you get 66 times, so 5 because one exists already. So, 55 times potential more demand for BTUs effectively. If you think about a spent tire, it's the ultimate manifestation of the energy that your economy uses. Is really incredible.
Yeah. Yeah. So shifting gears to the banking sector. The Fed recently came out with a report that said they saw 700 banks with unrealized losses exceeding 50% of their capital out there. What does the banking crisis, especially if it goes contagious or systemic, what does that imply? What are the downstream effects of, for energy, for commodities?
So I would be careful with those numbers because the banking sector is so swamped by the big 10, let's say, the top tier too big to fail banks.
Mm-hmm.
And so a lot of those unrealized losses are sitting on the balance sheets of banks that the government has effectively said is not going to fail, are not going to fail. And there's not going to be a deposit flight out of JP Morgan. If there is, we got bigger problems to worry about than the fate of the banking sector. And so that doesn't, minimize the risk to the regional and local banks, community banks. We wrote a piece called Regional Fallout a couple of months ago when this first started to unravel. 50% of the lending that drives the economy happens at small community and regional banks. And as we pointed out in the piece, we were served by one, and the Doomberg team. When we were launching, we had a meeting with the VP of private banking at our, local credit union. And she came to our office and she heard our business plan, and she's aware of our cash flows, and she satisfied her know your customer, anti-money laundering obligations by viscerally understanding what our business is and where the money's coming from and the timing of it. And if we ever needed to borrow money to grow our business or to try another endeavor, she knows who we are and she knows what we're capable of. And that touch would be lost if we end up doing sort of a Canadian style roll up where we only have 6 banks left at the end of the day. And the friction of the transition from here to there would be pretty awful. And so it is concerning to us, the incompetence on display by Janet Yellen in particular, but the sort of the federal government in general, as they haphazardly try to put Band-Aids on various wounds and aren't sort of engaging in look, banking is a confidence scheme, right? And so what stopped the banking crisis of 08-09? It was the bazooka. It was TARP. The government actually made money on TARP in hindsight. It was very controversial at the time. I remember vividly when the first attempt at getting it through Congress failed and the stock market literally crashed. And then that scared Congress, into passing it. We need a sort of a deposits bazooka in the US. And we fear that one won't be forthcoming because it's in the interest of the big banks for consolidation to occur, right? Last entity standing is a very profitable place to be in a sector like this. And so, I wouldn't be too concerned about the unrealized losses. And by the way, as interest rates come down, which, we talked about earlier, that problem gets better, right? And so these hold to maturity assets suddenly look a lot better on the balance sheet as interest rates come down. Interest rates are down off the highs, at least in the short end of the curve recently. And the market is pricing in a bunch of rate cuts. They're sort of calling Powell's bluff. As we're sitting here, the 2-year note is, which peaked out over 5% in March is now, 4.4% 4.2, let's say, round up a little bit. And so that helps, right? Like, and so if interest rates do come down because the economy slows or whatever, suddenly the bank's losses will disappear.
Right, right. So you kind of alluded to short term getting a bid in the United States. And that's kind of what we've been seeing is that capital flow has been coming into the United States, but it's been coming into short term assets. The 10-year and the 30-year haven't been getting a bid. How much longer? And that's just simply because there's nowhere else for capital to flee, at least from the minds of investors. Where are they going to flee to? The won, the yen, the euro. As bad as the circumstance may be with the U.S. dollar, it's still a lot better, a lot more preferable than all these other assets that they can hang their hat on. But it's all short term, right? So how much longer do you think until investors begin to realize gold as a place to store capital? Retail still hasn't really gotten into the game. Smart money, institutional investors still look at gold kind of in a condescending way, in the way that Warren Buffett tends to explain it as a pet rock. So do you feel like, or do you think that we're on the cusp of beginning to see more capital flight into gold as opposed to the United States, or how do you see that kind of shaping out in the course of what short term, midterm, long term?
Yeah, there's a lot of flows in this analysis. So the first and dominant flows is hopefully the imminent resolution of the debt ceiling crisis in the United States and ruling out the prospect of a default. As we're sitting here, the 1-year credit default swap on the U.S. is at a pretty substantial high. And that's telling you that the market is a little concerned. Now, generally speaking, the last 10 times this happened, it was sort of a Lucy's football, and they're not going to actually let the U.S. default. But political uncertainty in the U.S. is driving anxiety in the markets, which is disruptive to sort of the cleanest dirty shirt analogy that you were sort of alluding to with the U.S. dollar earlier. There's also the flow of what the BRICS are going to do with their own sort of de-dollarization agenda and whether gold will be part of the basket of commodities that are used to settle trade imbalances for 3 to 4 billion people in the world. We wrote a cautionary piece in this regard called Golden Handcuffs, where we describe the potential risk to gold owners in the U.S. that the government would outlaw private ownership again. It happened famously in the 30s. It could happen again. And our view is that some of the precedents being set in the crypto crackdown could very easily be reprogrammed, at least from a propaganda perspective, to attack the private ownership of gold. So it's not without some risk that we observe the movement towards gold by foreign central banks, in particular the BRICS countries, who have loudly expressed an interest to de-dollarize. And so we're owners of physical gold, and sometimes we express a market position in gold using paper, predominantly the sort of Sprott Physical Trust. But there's a lot to sort of unpack here, as there always is in the gold market. It's a very deep market with a lot of history, with a lot of liquidity, a lot of players, a lot of forces. But one cautionary one, counterintuitively, is if the demand for gold increases substantially because the rest of the world has decided to reincorporate it into the basket of commodities it uses to sort of settle trade imbalances, that could be actually a risk for Western-based gold owners as governments crack down on it in the same way they've done so with crypto.
Right, right. And actually, I interviewed David Morgan in the last episode, and he brought up a very fascinating thought experiment. So if we begin to run out of oil to the extent where we've got a very finite amount of oil, we've still got all the gold mines. Does there come a point where we just stop mining for gold just because it's no longer worth expending the limited amount of resources to extract it?
Yeah, we would not be in the we're running out of energy camp.
Okay.
We at a price you can produce all manner of energy deposits. So this is the distinction between sort of a resource, and sort of just a standard for a deposit. Like as energy prices elevate, it necessarily makes more and more previously uneconomical reserves, resources into reserves, I guess is the phrase I was looking for mentally here a second ago. Like there's accounting definitions for those terms. And at $200 oil, we have a lot more, quote, economically developable oil than we did at, 70. Ultimately, we have, if you listen to, the Rice family in the natural gas sector, we have a limitless supply of natural gas in the US at $5 per million BTU. And so the price just needs to go back to above $5 per million BTU, and then you will have this amazing supply of reserves as opposed to resources that are uneconomic. And so now we could be running out of cheap energy, and what that means for the manner in which we financialized our society could be profound. But, on the other side of a debt jubilee would have all the energy that we would need, in our view. And most importantly, it might actually begin to drive us back to nuclear energy, which is the highest energy return on an energy investment asset class there is. And we have, thousands of years supply of uranium in that regard.
Right. And uranium, I mean, when it comes to uranium exploration, development, production, building a nuclear power plant, that stuff I know for a fact takes like a decade minimum just to go through all of those different stages. So
that's a choice, though. That's a political choice. And Chris Kiefer from Canadians for Nuclear Energy just put out a great report on the CANDU reactor system and its history. And, they brought on 20 nuclear power plants over a period of 20 years because it was systematized, it was standardized, there was political support for it. They cut through the red tape. Like the reason nuclear power is expensive and the reason it takes a long time to bring it online is because we have allowed radical environmentalists to permeate our regulatory regimes and to purposefully put sticks in the wheels, to try to slow this stuff down. If we made a national commitment to a nuclear renaissance, a Manhattan-style project, Manhattan Project-style initiative, we could easily get it done. There are no technical or financial barriers to a nuclear renaissance. It's all self-imposed political nonsense. And so whenever I hear people say it's too expensive or it's too slow, I have to remind them that these are choices. There's nothing inherent about the highest energy density form of resources that we have that makes it expensive. We choose to make it expensive, and we could choose not to.
How do so I'm not really up to speed with how fast nuclear gets implemented in countries like China and Russia and some of the BRICS nations, where I'm sure they, there's not, they don't have to contend with all of these environmentalists that you alluded to. So is that how it is that how you kind of see it shaping up over there?
We don't have to look over there. We can look at our history here, both in largely Ontario in Canada and in France. If you go back and research the speed with which France, built out nuclear power to basically create the cleanest grid in the Western Hemisphere, we did that 40, 50 years ago. Why can't we do it now? What has changed technologically that makes it slower? Nothing. So we don't even need to see how fast China is building out nuclear power, although they are building it out incredibly fast. We can see what we used to do, and it worked. Our friend Mark Nelson likes to say, a modern nuclear power plant is effectively an evergreen asset. It never goes away. It can be maintained indefinitely. Certainly on the timeframes that we care about, which is decades. So I think something like the average age of a nuclear plant in the US is 50 years old. That means 50 years ago, we were able to build dozens of nuclear power plants quickly, cheaply, and they lasted forever. So why is it that in 2023 we can't do that? That's a choice. It's a political choice. It's a perverted political choice imposed upon us by radical environmentalists who are fundamentally Malthusian and anti-human. But it is a choice. Let's be very clear. We could choose tomorrow. If the United States chose to say we're going to double our nuclear fleet in the next 10 years, of course they could do it. They would start by saying, what is it that we need to do to get this done? Oh, We have to cut all this red tape. We have to pick a standard design. We have to build a supply chain that produces the exact same stuff over and over and over again and to very high quality. Period. It would be done. It can be done. It's a choice. We choose not to.
Interesting. That's a good point. I never really dig deep into the history of nuclear power, especially during the time periods that you kind of brought up there.
Like we've not gotten worse with technology in 50, 60 years, right?
Yeah.
I mean, so just look at, if you just, when we're done with this, go and Google Chris Kiefer CANDU, CANDU report. And he has a great chart in there that shows the build out of the Canadian nuclear power sector over a 20-year period. And then he superimposes sort of the current time period on top of that to give you some perspective. It's a really amazing chart. And it's very eye-opening. And you ask yourself, like, if Canada could do this all those decades ago, it can't be that we can't do it today, except it must be that we have artificially imposed political barriers by people who would rather not see us accomplish this. In fact, I'm pulling up the chart right now. So over a period of from early 1970s.
Do you want to share your screen, by the way?
I'll share this. Hang on, let's see what I can do for you here. We'll do this live.
Awesome.
22 reactors in 22 years. You see this chart from
early
1970s to the mid 1990s. 18 gigawatts of new nuclear power plants or 15 gigawatts of new nuclear power plants were brought online in Canada. So 1972, let's say 1973 is 50 years ago. They didn't have computers back then, right? I mean, well, who are we kidding? It's too slow. Well, no, we just decided to create a set of circumstances that made it slow.
Just sandbagging.
Exactly. In fact, this is all by design. The radical environmentalist Malthusians would rather we not have cheap, plentiful energy. And part of their propaganda campaign is to say that nuclear is too slow, nuclear is too expensive, and waste is unsolvable. All three of that are giant piles of steaming BS.
So what's the end game here? Like between this ESG movement, between the rate hikes, the regional banks consolidating under bigger banks, is there one overarching end game, or is it like you said, you're kind of more on the incompetence camp, or is there something more to it?
Well, I don't think it's a planned implosion. At the highest level, it's very bullish for Doomberg because we're going to have no shortage of crazy stuff to write about in the next 2 to 3 years. But all kidding aside, we don't know what the path function is out of here, except historically, there's always a regression to the mean. Yeah. And the human endeavor is upward sloping, up and to the right.
The ascension of man.
Yep. And so ultimately, even Germany, once it experiences enough pain, will figure out a way to right the ship. If you just look at the economy Germany created coming out of World War II, the complete and total destruction of their country, their industrial base, their culture. And then they went on to become the 4th largest GDP economy in the world, with high value add manufacturing and amazing world-class engineering. We're not going to reach anywhere near those depths. And so the climb out of the hole won't be anywhere near what we've already been able to accomplish. Back to this whole point about nuclear power. Like if we could roll out 22 new nuclear reactors in Canada over 22 years, starting 50 years ago, there's no question what we could do once we remove our self-imposed barriers. And ultimately, that's what makes us optimistic, sort of pro-human, and worth getting in the ring and fighting over these policies and advocating for our positions and so on. Yeah,
we're essentially in a human secular bull market, but we're due for a correction.
Yeah. And we'll come out, all such corrections create opportunities. And, as long as we don't get too close to the abyss, we should be able to regress back to the mean.
Yeah. And the regression to the mean there's always overshoots in either direction.
100%. And, we could see a huge productivity burst here with the rollout of artificial intelligence. We've not really written about it. We're not sort of getting into that hype cycle, but it is pretty easy to imagine a world where humans become radically more productive, which begins to solve some of our challenges, both sort of financially and environmentally and economically. And people do have a history of sort of underestimating the exponential growth of technology. And so there's lots of reasons to be bullish if you go look for them. One of the key problems we do have to solve, of course, is the confidence of our political leaders.
Yeah. So are there any, we've talked a lot of doom and gloom, appropriately so, given your Doomberg, but are there any opportunities that we can identify? Because all things being equal, me and my viewers, we'd much rather profit and make money off of it as opposed to, be miserable and poor with everyone else. So is there any sort of silver lining that you can see here?
So it's just from a cold analysis perspective, if I were an investor, we sort of talked about this with our pro tier in a webinar a couple of months ago. There's sort of three classes of opportunities we see during this sort of period of energy insanity. Just looking at the Inflation Reduction Act, for example, there's a fire hose of cash being thrown at these renewable supply chains. And then alongside that, there's a sort of co-investment commitment that comes with it, which amplifies, the law that was passed. So there's going to be no shortage of opportunities to invest in sort of quote high growth promotes where the businesses won't ever really make money, but for a while they'll be very exciting and the stocks will accelerate. We don't like to do that because we just find it very difficult to put money into an enterprise that we don't think will ever make money. There's another vertical that you could consider, which is what we call sort of the shovels to gold miners phenomenon, where there would be sort of a provider of a high barrier pinch point to these supply chains that can capture a ton of the value and they will make a lot of money. And it's okay to own those, but you always have to remember that they're kind of like a really great business whose headquarters is on the Titanic and sort of eventually have to go down. But then the third is sort of the contra. If you had had the wisdom to invest in coal at the sort of bottom of COVID as they were coming out of the crisis, you would have had a career making trade. Those are hard to time. But sort of the traditional money-making societal must-haves are always a decent investment with a good downside hedge. We much prefer to express our bullish intentions privately in the private markets because management in the private markets are forced to think about remunerating shareholders using dividends. Whereas on the open stock market, you can have ESG type cash flow deviations condemning you to a decades-long period of below average market multiples versus what the financial performance would indicate. And so it's hard to cash in on your good idea sometimes, whereas in the private market, you can work with management to have equity holders compensated in the form of dividends or takeovers or things like that. And so, and also in the private markets, we find that we can have a bit more direct impact and invest in smaller entities where we see that they're mispriced or you get in at a good price and help management exploit the assets that they have. But those are the three areas where if I was just looking to invest, it would be either in promotes, in pinch points, or in contras.
Gotcha. Understood. Well, I want to be mindful of your time, Doomberg. Before we sign off, though, are there any parting thoughts you'd like to leave the audience with? And tell us more about your Substack as well.
Yeah, no, we covered a lot of ground, and I think they can find more at doomberg.substack.com. Like I said, we are, this is our livelihoods now. This is the work of our lives. We publish 6 to 8 pieces per month on topics like what we just covered. And we are 100% subscriber supported. And so you're always going to get our authentic and provocative views. We don't have to bend our editorial standards to, sponsors or advertisers. Nothing wrong with those models, but given how provocative we intend to be and have been over the 2 years of this journey, we would rather rely on listeners to support our work, and many of them do, and we're very grateful for that. So really appreciate the opportunity today, and best of luck on this project as it evolves.
Yeah, thanks for coming on. Thanks for the generosity of time. So with that said, everyone, if you enjoyed this video, hit the like and subscribe if you haven't done so already, and I will see you in the next video. Bye, y'all.